Tonight, stop calling this political theater. The futures market is not treating it like empty talk, and your portfolio should not either. By around 7 p.m. Eastern, Brent crude was trading around $111 a barrel. Earlier in the evening, oil had spiked much higher, but even after pulling back, it was still sitting at a level that tells you the market is pricing real supply fear, not just headlines. This is not a quiet Sunday night. This is the market warning you that energy risk is back. Over the weekend, President Trump threatened to strike Iranian power plants if the Strait of Hormuz is not fully reopened within 48 hours. Iran responded with threats against energy, IT, and desalination infrastructure across the Gulf. That is why this story is bigger than oil alone. Hormuz is one of the world's most important choke points. When traders hear Hormuz and retaliation in the same sentence, they do not wait for a polished diplomatic statement. They start repricing risk immediately. Now, let's stay precise. This does not mean a full permanent shutdown has already been confirmed. Iran has also said the strait remains open to ships not linked to its enemies. But for markets, that does not remove the danger. A route does not need to be fully closed to damage confidence. If traffic is threatened, restricted, or politically filtered, companies still face higher shipping risk, higher insurance costs, and higher fuel costs. That is where margin pressure begins. That is why stock futures turned weaker on Sunday evening. S&P 500 futures were down about 0.2%, and Nasdaq 100 futures were also down about 0.2%. The message is simple. When oil stays elevated, the market starts asking who can absorb the cost and who cannot. Airlines feel it. Transportation feels it. Chemicals feel it. Fertilizer feels it. Industrials feel it. Retailers feel it when freight and packaging costs start moving the wrong way. The market is not just trading war headlines. It is trading the risk that inflation stays sticky while margins get squeezed. And that is the real problem for Monday. If energy stays high, Wall Street will quickly shift from geopolitics to earnings pressure. Investors will ask which companies still have pricing power, which businesses can protect margins, and which names are now exposed to a fresh cost shock. Oil does not need to make a new high tonight to keep that pressure alive. The warning has already reached the market. Watch oil, watch futures, watch yields, but above all, watch margins. Because when energy starts writing the macro story, earnings usually pay the bill. I'm Wilson. See you tomorrow.